Hello, this is Rex Crandell, and today we're going to be talking about Schedule C, which is a schedule that's attached to the personal income tax return, the IRS Form 1040, and Schedule C relates to income and deductions for business activities, self-employment. So let's get started. Class overview. What is Schedule C that is attached to the IRS Form 1040? This is what we're going to cover. Who must use this form? What kind of stuff do you have to put on Schedule C? What is taxable income and what is not? What can you deduct to make your tax bill as small as possible? Free enterprise in action with you being the boss. Types of expenses, including vehicle cost, depreciation, business operating expenses, home office costs, allocation of business and personal expenses, how to keep out of trouble with the Internal Revenue Service and the Franchise Tax Board. Before you get started, prerequisite to starting to prepare your Schedule C business report is having your QuickBooks or accounting system completed for the year with all your deductions posted. You should keep your bookkeeping up to date every month when you reconcile your bank statements. Accounting is fun to do anyway, right? Sure it is. Okay, so this is a snapshot of the Schedule C. Shows it's part of the 1040, profit and loss from sole proprietor. It also applies to the 1040, the 1040 SR for seniors, 1040 NR for non-residents of the U.S., the 1041, which is a fiduciary income tax return. All those entities use this schedule to report income. So let's get into more of the details here. We have, oops, wrong one. Okay, this is side 2 of the Schedule C, and it has cost of goods sold on the top, which will cover auto, little details on auto, and then a place to list other business expenses before bringing it forward to the actual 1040. Let me see here. Oh, it's this one. Ah, there we go. Okay. So self-employment comes with many perks, but when tax time comes around, it also means you will be filing more than just your 1040. Chances are you'll also need to file a Schedule C. The Schedule C form might seem daunting at first, but while it has several lines, 48 in total, you probably won't need to fill out every line, and most of the information required is straightforward and understandable. What is a Schedule C? You might be thinking of Schedule C taxes, but the full name is Schedule C Profit and Loss from Business Sole Proprietorship. It's one of those tax forms that does exactly what the name says. It calculates your business net profit or loss for tax purposes. It is an essential form when it comes to most small business income tax returns. Sole proprietors and single member LLCs need to fill out the Schedule C every year. Once you fill out the form, you'll file it with your IRS Form 1040. Who needs to file a Schedule C? There's a good reason why people sometimes refer to Schedule C as the self-employment Schedule C. If you're self-employed as either a sole proprietor or a single member LLC, you typically need to file a Schedule C. The sole proprietor means you are the business. You might have a trade name, but you are the owner. You're a sole proprietor if you're the sole individual running an unincorporated business according to the U.S. Small Business Administration. This means your business is not a separate legal entity on its own. as a sole proprietor, you'd be responsible for all the debts and obligations of your business, but you also receive all its profits. What about side gigs? Yes, the sole proprietor also covers side gigs. So if you had a side hustle on top of your regular employment, you'll need to file this Schedule C. Single member LLCs, limited liability companies. The sole proprietors often operate their business as single member LLCs. This is a popular business structure of ownership because it provides some limited liability protection for the liabilities of the entity and shelters the owners from the liability. Unless the LLC elects to be taxed as a corporation, the IRS views a single member LLC as a disregarded entity. This means that the single member LLC is not considered a separate entity from its owner for tax purposes. It does not file a separate federal tax return like a multi-member LLC or a partnership or a corporation. California does require single member, excuse me, single member LLCs to file a separate income tax return from its owners. It is filed on the California FDB Form 568, along with minimum franchise tax every year. So even though your tax returns for a single owner LLC is included on your Schedule C, you still have a separate tax return to file every year for California, Form 568, and that's where you pay your $800 a year minimum franchise tax fee. Only the IRS treats one owner LLC as a disregarded entity that does not need to file a separate tax return for its owner. For California, you must file a separate tax form so the LLC is not disregarded for California. If your LLC has one owner, you are the abbreviated SMLLC, single member LLC. If you're married and you and your spouse are considered one owner, you can elect to be treated as a single member LLC. However, if a married couple do not elect to be a single member LLC, then they are required to file tax form 565 as a separate tax return and not include with your IRS Form 1040. The advantage of a separate tax return is that you have a much lower probability of receiving an IRS audit. The California FDB, I call them the party poopers, require the separate filing even though you're considered a disregarded entity. And in addition to the $800 annual franchise tax fee, when your sales get above 250,000, that's gross business sales before expenses, they charge an additional 1.2% of the gross sales as a tax. What information is needed on a Schedule C? The name of the proprietor, that's you, your social security number, or an individual taxpayer identification, ITIN, if you are a non-resident alien for tax purposes. List your principal business or profession. IRS uses the information to evaluate the reasonableness of your expense deduction. Enter your business classification code. It's the North American Industry Classification System, abbreviated NAICS, is the standard used by federal statistical agencies to classify businesses for purposes of collecting, analyzing, and publishing statistical data related to the U.S. business economy. You can find this number by search feature at the North American Classification System at https www.census.gov /NAICS or from the Schedule C instruction booklet. Here we have a copy of the Schedule C, the upper part, and you can see you've got the name of the proprietor, social security number. If a person is an illegal alien, then you would get together with someone who you fill out the forms to get a federal ID number. It's called an ITIN, and then you send your ID with the application to the IRS to issue a new ITIN number that is used like a social security number. And if you have a fictitious business name, you list that, your LLC name if it's separate from you. And starting this year, there's a beneficial ownership information report due before December 31 for existing businesses to the IRS division called the Financial Crimes Enforcement Unit. And if you don't register, there can be large fines. If you have more than one member in your LLC, you're not filing this Schedule C, you're filing a Form 1065. So some of the questions here on the tax return list things that you need to disclose. On a business, if you're a single member LLC or working out of your home as a sole proprietor, some people will get a rented PO box, UPS store, FedEx store, postal annex to use as their street address for all publication purposes to keep their residents confidential. Okay, business address, we already covered that. Now we're getting into cash basis of accounting. The cash basis is a method where revenues and expenses are recorded only when cash is actually received or paid. This means that income is recognized when money comes in and expenses are recognized when money goes out, regardless of when the underlying transaction occurred. Transactions are only recorded under cash basis when cash is exchanged between buyer and seller. This approach is straightforward and often used by small business individuals because it provides a clear picture of cash flow. However, it might not accurately reflect your business's financial position or performance over time, especially if you have significant accounts receivable or payables that are due or receivable. Most small businesses do use the cash basis of accounting. The receipts and cash payments by the business are taxable income. Cash payments, okay, are taxable, contrary to uninformed opinions to the contrary. Be honest and truthful in all your financial reporting. Honesty is the glue that holds our entire society together. The next accounting method that's listed on the Schedule C is the accrual basis. It's a method of accounting where the revenues and expenses are recorded when earned or incurred, regardless of when the cash actually was received or paid. This means that revenue is recognized when it is earned, even if payments have not yet been received. Expenses are recognized when they are incurred rather than when you pay them. This method provides a more accurate picture of the financial health because it includes all income and expenses relating to the period being reported, not those where cash transactions occurred. All the publicly traded companies on the stock exchange are all on the accrual basis, but all small businesses are on the cash basis of accounting. The next question on the tax return, line G, did you materially participate in the operation of this business? The materially participate is IRS speak that you really worked in the business and you just didn't have a business and never showed up. There's a couple levels of participation: active participation, a less stringent standard than material participation. For example, you may be treated as actively participating if you make management decisions in a significant and bona fide sense. Management decisions that count as active participation include approving new tenants, deciding on rental terms, approving expenditures, and similar decisions. Then we get into material participation. You materially participated in a trade or business if you satisfy any of the following tests. You participated in the activity for more than 500 hours. Your participation was your participation was substantially all of the participation in the activity for the year, including the participation of individuals who didn't own a financial interest in the business. You participated in the activity for more than 100 hours during the year, and you participated at least as much as any other individual, including non-owners, for the year. Based on all the facts and circumstances, you participated in the activity on a regular, continuous, and substantial basis during the year. So, material participation. So what? Big deal. The whole purpose of this definition and tax rule is to keep rich people from plunking down a little bit of money, having a business that they never show up at, that somebody else runs for them, and then they get a bunch of tax write-offs. So it's to avoid tax shelter treatment. The next question is, did you start this business within the year? If yes, the IRS will look for pre-opening expenses that should be put on the depreciation schedule and not taken as a direct expense on Schedule C under Internal Revenue Code Section 195. What pre-opening expenses means is, for example, you're going to open a store, and for 3 months you're remodeling and fixing up the store, and then in the 4th month you open for business. Well, all the expenses paid before opening for business are called pre-opening expenses, and you cannot write them off this year. You have to move them to the depreciation schedule and then start depreciating them after the business was opened. So you can deduct, after you have the business open, you can deduct up to $5,000 of the business startup costs paid before the business was open. The remaining startup costs can be deducted over a 15-year period. The downside is you do not get a tax deduction now for your full startup costs. The next question on the top of the Schedule C is, did you make any payments that would require you to file a 1099? Well, in that case, that's if you hired an independent contractor that was not an employee and you paid them over $600, then you have an obligation to issue that person a Form 1099 NEC, give it to the vendor, and also give a copy to the IRS. These are for services of someone who's not your employee, which would include parts and materials. Payment to attorneys, including law firms or other providers of legal services, would get a 1099. A person means a human being receiving money from your business. You paid more than $600, not a corporation. Then you'll issue the Form 1099 NEC and file it with the IRS. If you pay a corporation or multi-member LLC more than $600 for the year, you do not need to file a Form 1099 NEC. Then it asks you, if yes, did you or will you file the required Forms 1099? So you answer that question, yes or no, under penalty of intimidation by the government. Income, at the top of the return, we have gross receipts, cost of goods sold, and gross income. Most businesses will not have this cost of goods sold unless they're retail or wholesale type businesses. The vast majority of businesses that I encounter are service businesses. There is on the back of the Schedule C the computation if you have products. How do you count for your inventory cost, lower cost or market or other? The way the inventory is calculated in accounting school, it's kind of like a jingle. The beginning inventory plus purchases less your ending inventory equals your cost of goods sold. So you take what you started with, what you added, and then you subtract out what you have at the end, and it leaves what went out in terms of inventory for that year. Now we get into the expense section. It says Part 2, expenses for business, but not for the business use of your home. A business expense is a payment that is directly related to the operation of the business. This payment is ordinary and necessary for the business. Hiring a babysitter so the parent of a young child may be necessary, but it's not directly related to the operation of the business. Therefore, it's not a business expense and would be considered personal. Would the expense seem reasonably related to your business if an independent third person, like an IRS auditor, gave their opinion? If a payment included elements of business benefit, but also included a part of the expense that was for personal non-business benefit to the owner, then the expense will need to be split into its business percentage in order for it to be deductible. One thing you can use is what we call the straight face test. If you can not tell a third party about what you're deducting without laughing, then no, it's not a business expense. You're stretching the rules. Okay, so this is a list of a lot of the expenses on the Schedule C from lines 8 to 27. So we start out with advertising, car and truck. So it gives you some choices. You don't have to use these categories. On line 27A, there's a schedule on the back of the page 2 of the Schedule C where you can use other categories and just list the ones you want. And I encourage that for the company to track expenses based on what they call that particular item, like inventory or special materials and things like that. So car and truck expense, you have two options when claiming the auto expense. There's the standard mileage rate and the actual cost operating expenses. The standard mileage rate is somewhat simple. You can use this option if you own the vehicle and have always used the standard mileage rate when claiming it. If you're leasing the vehicle and you're using the standard rate for the entire time you leased it, for tax year 2023, you were allowed to deduct for business driven miles 65.5 cents a mile. And for tax year 2024, you can deduct 67 cents a mile for your business driving. So that's just based on your mileage. Now we're going to get into the actual operating expenses. Here you keep track of your gas, oil, repairs, maintenance. When using this option, you include the business portion of your vehicle expenses, such as gas and insurance. If you choose this option, you'll need to fill out line 3 which is depreciation of your vehicle, and include any lease payments on line 20A of the Schedule C. No matter what option you choose, it's important that you have evidence to support these claimed auto expenses, such as receipts or mileage logs. So determine your business use percentage. This is a worksheet that we use, came from our software. Determine the business use percentage for the vehicle. So in this case, example, there's 13,000 miles for business and 28,000 miles overall. So that indicates that 46% of the business miles or driving has to do with business related, and then everything else is personal. Now, when you're taking the actual cost method, you gather up all your total vehicle expenses for the year by category, and then you apply the business use percentage to reduce those expenses. So in this example, we have 4,500 of gas. We know 46% of it's business, so in our right column, we're only looking to deduct the 2,100 for the gas. So we list all the actual expense and then break it down to the business use percentage. And the business use percentage for this vehicle example is 5,688. Yeah. Come in. Okay, so now we'll look at the standard mileage rate for car and truck expense. So in this case, we're showing 13,000 business miles at for 2023, 65.5 cents a mile. And so that standard business mile expense is 85.15. And then you take all the auto and tolls and interest, you don't break those down. And then well, actually you do. You take the interest loaned on the car and you break that down, reduce it to the business component. And using the standard mileage rate, we come up with an expense of 10,265. So we're calculating expenses on two different methods. One is the actual cost, and the other is how many business miles. And then you pick the higher of the two expense items. So in this example, the actual cost for business use was $56.88. But by using the standard per mile optional method, we have an expense of 10,265. So that is what you use for the expense, and you bring that expense forward to the Schedule C line 9 as your auto expense. So here's an example of the entire form in one page. So we have the business percentage developed. Here's 46%, actual cost reduced. So only the business expense left over, the mileage method, and it works out pretty well. There's quite a lot higher expense in this method for the standard mileage rate. And so you take the benefit of it. Now, there's another thing when you deduct your mileage based on the standard mileage method, your car's depreciating, but you're not showing depreciation for your vehicle. So the IRS will have you calculate how much depreciation is taking place when you're using the standard mileage rate. And so for 2023, the rate of depreciation for the standard mileage rate is 28 cents a mile. So you have to keep that record every year. So when you sell the vehicle, you take the cost of the vehicle less the depreciation you claimed, and then you compare that to your sales price to determine your gain or loss on the sale of that vehicle. Okay, so we're going down through the business expenses. Now we're going to talk about contract labor. It's on line 11 in Schedule C. And what that means is you paid for a service from someone who is not a corporation or a multi-member LLC, and they're not your employee. You do not deduct the labor from payroll that you're reporting on other lines in the tax return, because that's not contract labor, that's wage labor. So salaries and wages on line 26 are not duplicated here. When you hire an independent contractor for your business, you end up needing to report to the IRS and to the worker a 1099 NEC showing the amount of money that you paid them during the year if it exceeds $600. You should also be concerned about the IRS and contract labor, because oftentimes the IRS and the California Employment Development Department want to take your independent contractors and call them employees. And when that happens, it creates a large tax liability and penalties for the business owner. So I recommend people not use the independent contractor method unless the person's actually in a business and working for a lot of other customers. Okay, so the depreciation and Section 179 is just a term for a fast write-off of depreciation. So the definition, the depreciation is an annual deduction to allow the company to recover the cost or the investment in the business over how long they think the life of the asset's going to be. If you buy equipment that lasts for longer than a year, it will likely be indicated on your depreciation schedule. But if your business owns property such as buildings, equipment, you cannot deduct the full amount of your purchase for that asset in the year you bought it. You prepare a separate depreciation schedule and only claim a portion of that cost over several years. You can deduct buildings over residential buildings over 27 and a half years. You depreciate commercial buildings over 31 years. And when we're talking about depreciation on real property, that's you're only depreciating the building. The dirt doesn't wear out, so you have to make an allocation between the building and the land. There's also another type of depreciation called Section 179 expense, and it allows all or part of the cost bought for the year to be deducted in 1 year. For years beginning in 2024, the maximum amount you can write off on Section 179 expense is 1.2 million. But this Section 179 does not apply to real estate. Talk to a tax professional if you're claiming depreciation, because it can be complicated. This is an example of a depreciation schedule. So let's say we have a truck, costs $49,000, 100% use for business, maybe a dump truck, for example. And then you depreciate so much of that truck over, in this case, 5 years. So you deduct $2,400 in year 2023 because you bought it near the end of the year. So you're really only claiming about a month of depreciation in this example. So you're depreciation schedule might be several pages long. And in this example, adding the prior cost of the items, assets on the depreciation schedule is $348,000. And then the current depreciation for all the assets is $56,000. You also have to accumulate how much depreciation you claimed before on each particular asset. Employment benefit plans, and these are other than line 19 pensions. Deduct contributions to employee benefit programs that are not an incidental part of a pension or profit sharing plan included on line 19. For example, accident health insurance, group term life insurance, dependent care assistant programs would be deducted here. You cannot deduct contributions you made on your own behalf as a self-employed person. So, the employee benefit programs. Okay, so we're going down the list on the different types of expenses indicated on the Schedule C. The pension and profit sharing plans, enter your deduction for contributions you made for the benefit of your employees for pension, profit sharing, or annuities. They have various names like SEP, Simple Plan, SARSEP. Some of them are called 401ks, including an IRA, individual retirement account. If the plan is included, you as a self-employment person, then the contribution made as an employer on your behalf on Schedule 1 of the 1040, not on the Schedule C. In most cases, you must file the applicable form listed below if you maintain a pension or profit sharing plan or funded deferral compensation. And when you have a company pension plan, the reports can be quite complicated that you have to report every year. Rent or lease payments. We're looking at expenses. So in this case, we rented a truck, let's say, or machinery. And that's for regular rental of equipment. Keep the vehicle lease payments in the auto expense worksheet. I would not list them here. Rent paid for machinery and equipment is self-explanatory. And then rent on other business property, most common is rent of an office or a warehouse. So you only enter information once on the tax return. You don't list it in a couple different places. Duplication of data is very confusing and likely will result in tax preparation errors. So repairs and maintenance, we have car repairs. I still recommend using the car expense sheet, not listing them under this category, line 21. All other types of equipment or building repairs can go here. So we're talking about the repairs and maintenance section on line 21. Okay, so the next item are supplies expense. These are things that you use in the business that are not products resold. And there's an assumption that when you are using supplies that they're not going to last for more than a year, they're going to be used up. For example, copy paper, pens, paper clips. If you buy equipment and other assets that are going to last more than a year, then and they cost maybe more than $1,000, then you should be putting them on a depreciation schedule. Tax and license. This is for general tax and license purposes that a business is required to pay. You do not list payroll taxes because those are listed with wages on line 26 below. And don't get carried away with taxes, breaking out sales tax and showing it separately. It's a complete waste of time. So now we have travel and meals on line 24. So you'll notice it says travel and meals. It does not say entertainment. It used to be travel and entertainment, but the government changed the tax law and entertainment's no longer deductible. Okay, so travel expenses, this is the ordinary necessary business expense of traveling away from home for your business, profession, or job. You cannot deduct expenses that are lavish or extravagant or that are for personal purposes. Must be business related. Your travel away from home on a business for substantially longer than an ordinary day's work, you'll need to get sleep or rest for the demands of your work. So that creates a travel expense. Basically, you could not get home comfortably because of the distance. Deductible travel expenses while away from home include costs, for example, airplanes, trains, bus, cars. Um, and if you get a ticket for airline on the frequent flyer program, you do not show that as an expense or income. Other travel expenses, taxis, airport, transit, um, to and from hotels to your customers, shipping baggage, um, and using your car while at the destination, you can deduct the actual cost or the standard mileage for that, or you can rent a car and deduct the business expense there. Lodging does become deductible. You can even do laundry, dry cleaning, and get a deduction there. Business calls, also deductible, and tips you pay for any of these services are a deduction. So now we're on the meals section. Meals are deductible subject to a 50% deduction limit. So if you had a bunch of meals entertaining customers and it ran up to $3,000 for the year, you would only be able to deduct half of that, or 1,500. So it's the expense is based on the actual cost of the meals, including tips, and you must keep receipts to justify your expense. And also, if it's entertainment, put the name of the client there also. Business-related entertainment expenses include deductions related to entertainment facilities, are generally not deductible. So this might be a clubhouse or things like that. Per diem rates, what a per diem rate, we're talking about meals, entertainment, and actual costs. Per diem means you get a deduction based on kind of a standard national standard that the government came up with. They use the term within the continental US. I've given you a link here that shows the per diem rates for travel. So it might be if you're traveling in Houston, Texas, there might be $178 a night for a hotel. And you would deduct that even if you didn't pay that much because of the per diem. And they have per diem deductions for meals also. This is the state portal for the standard expense for meals away from home. The utilities expense, this is self-explanatory. Things you pay for your business and electricity, gas, water, sewage, internet. If it's for a home office, only the business portion is deductible. Wages expense, it includes the total amount the business spent to compensate the employees, including wages and salaries for work performed in employment benefit programs, payroll taxes on a business, such as Social Security, Medicare, unemployment, bonuses and commissions paid to employees for sales performance. Now we're on the section of the tax return that's called other expenses. So we list that on page 2 of the Schedule C, and it provides room to list the expense, and then you pick what you're going to call the expense name and list it out. What I'll do oftentimes, if I know there's an expense that is business and personal, I will show, like in this example, telephone internet expense, and I put 80% business use. So the IRS knows that I'm only claiming the business use percentage, and I think it helps reduce audits because the IRS sees that you're conscious of not deducting personal items, but only the business component. Now, we've gone through all of the categories for the expense accounts, and then we get to the total expenses and tentative profit and loss. So what we did is we took the total income, deducted the expenses all the way through line 28, and then we end up with a tentative profit. And you have to pause there because you cannot have any home office expenses above where the lines we're talking about here. So you keep home office expense completely separate from the expenses that we've been talking about. So let's look at the home office deduction. There's one method that's called the simplified option. It does not change the criteria for who can claim a home office. You have to have a principal place of business, or it's used regularly and continuous for business purposes. It just simplifies the calculation and record keeping for the allowed deduction. Highlight of the simplified option for home office, you can take a standard deduction of $5 per square foot of your home used for business up to a maximum of 300 square feet. The allowable home-related itemized deductions are claimed in full on Schedule A. So what we're talking about there is if you claim a deduction for your home office and the personal use is not deducted, that personal use can be treated as an itemized deduction to reduce your taxes. So now we have the comparison of the rules of the home office. First of all, you have income and expense, and if you have a loss, or if the home office creates a loss, you cannot claim the deduction. Okay, in other words, you cannot use a home office to create a loss on a business. And if you're using the $5 a square foot method and you have a loss that you're not deducting because it's limited, on the standard method, you cannot carry that loss to be used in future years. However, if you're using the regular method, which takes all your home office expenses and reduces it down to the business component, and you have a loss, then you are permitted to carry that loss that you couldn't deduct this year. you carry it forward to next year and use it at that point. There's a form that helps feed data to the Schedule C, line 30, and that is Form 8829, expenses for business use of your home. Okay, so it starts out with what's your square footage of your business use. And when they say business use for home office, they mean that you have an area that's only used for business. It does not mean you have a couch in there and it's in the living room and you claim the whole living room as your home office. That does not work. The rules say that it can only one activity in that room or area is used for business, not mixed use unless it's a daycare. So if we had 300 square feet of business, which might be a room, it might be part of the garage, and then the total square footage of the house, in this example, is 2,000 square feet. So we're looking at a business, home office business expense of 15%. Okay, so moving right along, now we have two columns to put expenses, like real estate taxes and insurance and things. And the definition for the first column is direct expenses. What that means is it directly benefited the home office. So if you hired a painter to paint your home office and it was one room, then that would be a direct expense. It did not impact the rest of the house. So most of the expenses come under what's called indirect expenses, and those are ultimately reduced by taking out the personal use, only leaving the business deductible item. So in this example, we have mortgage interest, real estate taxes, and then we apply the business use percentage and get a deduction of $7,900. Then we go through other lines like insurance, repairs and maintenance, add up all those at 100%, and then multiply that times your business use percent. And then we come up with a total cost of your allowable home office expense on line 36. Then we go into part 3 of the form 8829, and that's where you show the standard method for home office, simplified method. In this example, we had 300 square feet of exclusive use business area at $5 a square foot, so we get $1,500 deduction using that method. And so then we enter the net profit or loss after that expense. And so we take the profit and loss before the home office. If it's profit, net income, then we can deduct the home office, and then we come up with the net income overall in the business, and that net income gets taxed two different ways or moved two different ways. One way is it goes into computation of your income for your tax bracket, your regular tax bracket. The other way that this net income is utilized is it's for self-employment tax. That's the business owner's Social Security, and then we fill out a Schedule SE for self-employed tax, and we apply 15.3% of the net income, apply self-employment tax or Social Security in addition to the income. And people say that that's ridiculous. Why is it so high? Well, if you compare it to a W-2, where you have Social Security withheld from your wages, the employer pays half of your Social Security, and then the employee has withheld the other half, but it still totals 15.3% of the salary. So on the self-employment schedule, you're working from the net to go to Social Security calculation, SE tax. And on a W-2, you're working from the gross to get the self-employment tax. And then at the bottom of the home office, they want to ask if there's anything that has to do with that risk. They're trying to knock out people from using tax shelters. Okay, so on the net income, I mentioned that you have additional tax called self-employment tax. And in our example, let's say we have 188,000 of income, and the net on the Schedule C is taxed at 15.3% for the owner's Social Security account. So that ends up being 24,900 for the self-employment tax that you have to pay. You add that to regular income tax and you pay both. You get a somewhat of a deduction for half of the self-employment tax to reduce your taxable income. It's kind of a consolation prize. So this is the entire Schedule SC. We have the income, the application of the rate of 15.3, and then the deduction for the self-employment tax. So then the at-risk limitation are rules to restrict losses of businesses in excess of what the person has invested. So these include what you have invested, cash contribution, if you're personally liable for business loans or assets, things that are not at risk. If somebody gave you a loan and said, pay it back if you make a profit, but don't need to pay it back if you don't, then that's a non-recourse loan, and the investor is not personally liable for the debt. So you cannot get deductions from that type of money that's used as an expense in a business. So it's a tax method to prevent taxpayers from claiming a loss of their actual financial exposure. So it's the amount that they've got at risk. And there's a separate form, a 6198, where you have to run a calculation if there's anything at risk, especially if you have a loss on the Schedule C. The IRS will probably require the Form 6198 to determine how much you have invested in that property. So that's what did we cover today for businesses? We covered what is a Schedule C that's attached to a 1040. We covered who must use it and what kind of stuff you have to put on a Schedule C. What is taxable income, what's not, what you can deduct to make your tax bill as small as possible. And we're looking at a free enterprise in action where you're the boss. And we covered a lot of different types of expenses, including vehicle depreciation, operating expense, home office, allocation of business and personal expenses. And we also covered how to keep out of trouble with the Internal Revenue Service and the Franchise Tax Board. So now you have been exposed to everything you need to know about Schedule C. And we'll have a test later to see if you remembered everything. Thank you for listening.